I'm Teddy Downey, Executive Editor here at the Capital Forum. Today, I'm pleased to be joined by Andrew Granato, Assistant Professor at the University of Texas School of Law, and Pranjal Drall, a J.D. Ph.D. candidate in financial economics at Yale University. We're going to be talking about their paper, Private Credit State Backstop, How Private Equity Socializes Risk Through Insurers, which examines the growing role of private equity-owned life insurers in private credit markets, the risks associated with those investments, and how the state insurance guarantee system can shift potential losses onto competing insurers and taxpayers. The paper is so good. It's 60 pages. It's an easy read, though. It actually is an easy read. I loved every minute of it. Please read it. If you have not read it, please read it. You're doing yourself a disservice if you don't read it. But Andrew and Pranjal, thank you so much for doing this today.
Thank you
Thanks
for
for
having
having
us.
us.
So I think I always like to start off, particularly in a paper like this, where I think the perspective is really interesting. You take a different lens from a lot of the other people who are writing about private credit and private equity and insurance. And I would love to get a little bit of your background, how you came to write this together, and how you came to look at it from the perspective that you did.
Yeah, so I used to work at the Federal Reserve Bank of Chicago in their insurance initiative unit before I went to grad school. So I did the same program that the Pranjal is in right now. I'm kind of a couple years ahead, and so I'm starting as a professor. But I have a lot of background in insurance and in particular, like kind of the tax law of insurance.
And I usually work on, so recently I've been working on frictions in asset valuation. So basically, like how problems of valuation create various kinds of problems for the financial system. And part of that is obviously studying private credit, and I have some other work on private credit in different contexts. But Andrew and I started talking about this project like 6 months ago, like or February-ish. And we are like, I do private credit, Andrew does insurance. And there's like a nice paper waiting to be written here where we'd noticed the trend of PE buying insurance companies and thought there's like a paper here somewhere, and we started working on it, and we're able to finish in like a 6 month span.
I mean, it's a really complex space. And if to not, I don't know how much of your time you're able to spend on it, but I mean, to get this much clarity in a short amount of time, I think was really impressive. And in your paper, you talk about how, places like McKinsey and just generally people who like this industry talk about how private equity buying insurance companies creates a flywheel. It makes a lot of sense to match up illiquid assets from private equity with these insurance policies that don't need to be paid out until much later on. But to me, reading your paper, I'll be honest, it felt like a very complex scheme to defraud the public, which I would include as taxpayers, policyholders, and maybe even investors in some of these vehicles through private equity and private credit self-dealing and this sort of elaborate ways of hiding risk from regulators and investors. Obviously, those are two diametrically opposed ways of looking at what has happened here. But for our listeners, maybe you could walk us through how private equity decided to buy insurers, life insurers, and how that changed incentives in the industry.
Yeah, so this story, I think, starts, in the aftermath of the 2008 financial crisis. That's also the story of kind of the start of like the private credit industry as we know it today. Dodd-Frank is passed. It gets more difficult for banks to, make these kinds of loans themselves. Other investors kind of step into, this area. There's potentially also increasing demand from the borrower side as well for these kind of bespoke loans that have kind of particularized loan conditions that are not publicly traded, that are often made directly and often held to maturity. And so there is like in the telling of in the kind of the flywheel metaphor of all of these, as you say, great synergies. between that asset management model and the liability side structure of insurers, where most of insurers' liabilities are kind of the actuarial reserves for policyholders. You can think of policyholders to an insurer being kind of people who've made quasi loans to an insurer. They are paying premiums to that insurer upfront, often for very long periods of time, and they may or may not actually get payouts from that insurer. What they're doing is they are covering their risk, and so they are transferring the risk of having, to make payouts to that insurer. And the insurer pools these risks, and so in an expectation, it has to make, some certain amount of payments, but it doesn't know to whom. And those payments are often very far in the future. When people buy a life insurance policy, potentially they say like, oh, I buy a 10-year term life policy. If I die in the next 10 years, the insurer makes a payout to my beneficiary, or they potentially buy an annuity. They contribute all this money up front to the insurer, and then the insurer will make slow payouts to the policyholder over time, for the duration of that policyholder's life. So that story of the kind of virtuous synergies of the flywheel, we want to emphasize that we think it's not wrong. We agree that there are these natural synergies between the kind of long-term, like a liquid loan side of making private credit and the relatively stable long-term liability side of the insurer. What we want to say is that if the story ended there, that would be a deeply incomplete telling of what is really going on, which is, as you know, is the rise of this entire, model in which the kind of private equity buyout funds, the private credit funds, and the life insurer are all under the control of the same entity. And so when you have that situation, the thing that there's many differences between holding the private credit loans on the balance sheet of the kind of private credit fund versus holding it on the balance sheet of the life insurer. And so I'll turn it over to Pranjal to talk about like why those differences are so crucial.
Yeah, I mean, another way to think about it is private equity needs to, like insurance company takes a bunch of money from policyholders, invests it, earns a spread, and then gives back the policy, whatever they promised 20, 30 years down the line. In order to make investments, you can MetLife can hire a bunch of people to make investments on their behalf. But as you can imagine, a lot of 25-year-old Harvard MBAs don't really want to work at MetLife. They'd rather work at Apollo or like a fancy PE shop. So insurance companies are able to outsource this investment decision making to private equity in some way. And there's like various sorts of arrangements you can have between the insurance company and the private equity company. And it's just a way, so like a very benign way to think about it is like, instead of having the insurance company make investments, you can have the PE company make investments and on your behalf. Now the story sounds fine. That's like economies of scale. PE shops have built great businesses investing people's money. Why don't we let them invest insurance holder premiums so they can, make more money for the insurance company? And in expectation, also offer better deals to the policyholders, because you can like reduce prices and give them higher payouts if you're able to make more money.
And there's competition on that bid potentially for that work.
Exactly. Like, I mean, insurance companies, some of them are holding $300 billion in assets, and that's a lot of money in fees. So Blackstone and Apollo and KKR are competing for that business. So you can imagine like the fees are fairly tight in that setting. A different way to think about it is Apollo, instead of like competing in that business, would rather own an insurance company, have it all be internal to the asset manager. And that's sort of the trend we highlight is sort of more, complicated or problematic in that the insurance company, when they lose bargaining power to sort of bargain on behalf of policyholders, and they become part of this bigger asset management umbrella, then they cede more and more control to the PE shop and have them make not only investment decisions, but also how much fees to pay. So, right, like they can just pay themselves higher fees. Or when they buy assets, they can buy assets at a markup when they're buying from their own asset management's different business lines. versus when they buy loans from a different non-PE portfolio. So that's sort of the problematic end where just by ceding control of the insurer, the policyholders lose out in expectation.
Your paper actually has an example of when it is to the parent company PE firm's advantage to make the insurer insolvent. That seems like a deeply problematic, concerning conflict of interest. But I want to also lay out you sort of very explicitly lay out 5 ways that private equity companies can effectively loot their insurers to the detriment of the insurer. And you don't talk about this, but like obviously everyone that works at the insurer essentially is harmed by that. The policyholders and uh, taxpayers who effectively rescue the insurers when the insurers go belly up. And the 5 ways you list, you say P firms may drain an insurer by assigning the insurer's asset management or other tasks to fee charging affiliates. So basically just extracting a bunch of fees. Uh, P firms may strategically offload poorly performing or excessively borrower-friendly loans from affiliated private credit funds onto the insurer at inflated prices. P firms may reorient insurer portfolios toward affiliated, structured, and private credit that offers higher promised yield but creates greater loss and severe stress. P firms may engage in valuation arbitrage with NAIC's risk-based capital regulatory regime to make their private credit assets look systemically less risky than they actually are. PE firms may expand the use of opaque shadow reinsurance that conceals risk. This looting of the insurance company seems deeply problematic to me. I would love to go through these one by one. Uh, Tell me about these fees and how these fees add up. Where do these fees come from? What are the sort of problematic fee charging things that you see?
Great. So again, going back to the hypothetical, say an insurance company is fully owned by a PE company, you can make the insurance company pay higher fees to yourself. So the basic idea is every dollar you invest for the policyholder, you can say make 20 basis points on that. That's like the most direct form of like extraction in that the fees are getting paid out today just for investing. And obviously the investment and in the paper we cite some other empirical work that shows once a PE company buys an insurance company, they offload investment staff at the insurance company, but whatever money they save, they pay out in fees to the broader sort of asset manager. So again, you might think that's kind of benign in that someone has to invest the money. That investing money costs money, and you can pay out in fees. But the point is like the bargaining power, where like a PE company, when they own an insurance, just can pay themselves way more. The other sort of more implicit and like hard to empirically study fee extraction would be an insurance company pays out other costs, so like IT and like HR and a range of other services that they get. A PE company might have a bunch of portfolio companies that they make equity investments in, and they can use those services from the insurer. So like, some of these insurance companies are gigantic. They represent like 5-10% market share. So they support other portfolio companies of the PE owned that are owned by PE in different lines of business. So there's like the direct fee extraction. There's also this sort of let's support other PE businesses by just using their services. And again, there's not a lot of bargaining, so you can just take a lot of the policyholder money and pay inflated fees.
So,
Yeah, and the background here is, you might think like, well, if the private equity firm, if they own these other companies, they also own the insurer, and they're conducting these internal transactions. Like, well, maybe the insurer get kind of relatively loses, but why does that matter? Because they're just all just kind of part of one big company. And the reason why is that it is only the insurer part of the private equity firm that is subject to this unique insurance regulatory regime called an insurance guarantee fund. An insurance guarantee fund is a public backstop for the policyholders of an insurer. I think listeners will likely have heard of federal deposit insurance. This is a regime that functions somewhat similarly, though it differs in important ways, for bank depositors. So, the reason why, you might be very confident that your checking account is secure, even in the event if your bank goes insolvent, is because you are insured on that money through the Federal Deposit Insurance Corporation. And, similarly, insurance policyholders are insured on their insurance through state level guarantee funds, up to certain statutory caps. And so what this ends up meaning is that I think you should consider who are the funders of each of these different businesses within the PE firm's portfolio. So if you have the buyout funds where the private equity firm is, the general partner, and then they have LPs who are often these like large institutional investor clients, pensions, family offices, university endowments. These are a relatively small number of investors who have a ton of capital each and who are kind of repeat players in this market who, the private equity firm has like incentive to keep them happy because, they want to be able to continue to invest on their behalf and earn fees on those investments. The life insurer on the other side, who funds the life insurer? It's the premiums of this dispersed retail base of policyholders. It's just random people all across the US, none of whom individually is particularly important to the insurer, and none of whom has strong incentive to monitor what the insurer is doing, partially because, they are a relatively small creditor to the insurer, and partially because they have this public backstop. So I would imagine there are a lot of people in the audience who have life insurance policies. Like, has anyone ever thought to check what does my life insurer do with this money? I doubt I certainly haven't. Um, and so when you combine that with the fact that the insurance guarantee fund enables a public backstop for the policyholder, that creates this like consistent asymmetry in incentives for who the private equity firm has an incentive to favor when conducting these internal transactions within the firm.
Yeah. So basically, you're saying that, look, if the parent company was going to have to pay for this insolvency, it wouldn't be as big of a deal that they're feeing themselves to death or whatever. They're, uh, you know, taking money from one pot and putting it in another. But what you're saying is actually, if the insurer goes belly up, the people that get left holding the bag are the policyholders. The amount that is not guaranteed of the policy. So let's say you have $1 million policy, only 300,000, you lose $700,000 for, your spouse who's trying to collect after the other spouse has died or whatever. As you say, very, in a very sympathetic, customer, potentially, they're losing 700K or whatever they're losing if they have in excess of 300,000. But then the taxpayer in 40 states is actually the one that ends up subsidizing rest, because the vast majority of the rest, because the remaining insurers that pay into the guarantee fund get a tax credit against that. So the bag holder is the policy holder and the taxpayer in each of these states, not the parent
Not the
company.
parent. Yeah, yeah.
Yes. So the way that insurance guarantee funds work is that if a life insurer goes insolvent, we have this guarantee to the policyholders that depending on the state, maybe something like the first $300,000 of their insurance policies are guaranteed. So the state regulator has to take over the insurer and then decide, like, okay, well, first we look at how many assets are left over in the insurer. Are they enough to make these like expected payouts? Well, the insurer is insolvent, so probably not. And so then they have to go and they have to find a way to raise money to, make policyholders whole up to these caps. And the initial way that they do that is they actually bill every surviving life insurer in the state. So if you're some other random life insurer and you happen to sell policies in, Ohio, and an insurer that operates in Ohio goes down, well, congratulations, you just got a bill for your proportionate share based on premium volume to bail out the policyholders of this other insurer. And then So initially, the burden falls on the rest of the industry to bail out the policyholders. But then, as you know, in the vast majority of states in the United States, state law provides insurers a tax credit for these assessments that can be taken over a period of roughly 5 to 10 years. So, because there is a tax credit that offsets this burden to the insurers, the burden actually shifts to the taxpayers almost completely. The insurer has to front the money, and so they lose like kind of time value of money, but the actual financial liability is ultimately placed on the taxpayer. So, in 2008, when taxpayers had to bail out financial institutions, this was this like legislators had to vote on it. It was extremely important. This was a signal moment. Um, but in the insurance context, this taxpayer bailout actually occurs automatically in the kind of the most obscure way possible that minimizes, I think, the probability that anybody would even notice that it's happening.
Yeah. Yeah. You mentioned the paper AIG didn't have to go through this process because they got bailed out by TARP. I want to come back to the insurance. I want to come back to the guarantee stuff later. I just want to get back to all the different ways that PE is looting the insurance company. I mean, but I do think I want to make it very clear. You're saying that the bag holders are the policy holders and in many cases the end the taxpayer. So you may not know it, but 20 years from now, 10 years from now, 5 years from now, 2 years from now, if any of these go belly up, your park isn't getting fixed, your trash not getting picked up, your public school's not getting funded. I mean, your services in your state may be harmed by this looting that is currently going on. Let's go to the second one here. PE firms may strategically offload poorly performing or excessively borrower-friendly loans from affiliated private credit funds onto the insurer at inflated prices. Tell me about that. I mean, because
Yeah,
I see that and I'm like, so you're a PE firm, let's say you can't sell off the
yeah.
firm that you're buying out, you're like, hey, let's just make loans to either the fund itself or the struggling companies, and like, no, there's not a good market for that. So like, let's load it onto our insurance company asset balance sheet because like we can't sell it anywhere else. Am I oversimplifying it? Tell me about what's going on
So
here.
I think the intuition is exactly right. So these are all loans, so there's no like equity, but the idea is the same. Where recently there was this company, PE company called Blue Owl, and Blue Owl has a private credit fund that was in talks of being merged after they got a lot of redemption requests, and they were in the news for like failing to meet redemption requests of very sophisticated investors. Think your endowment, pension fund, those kinds of LPs. And in light of that, instead of so they have two kinds of funds. Ones are completely private that do not have any whose valuations are basically reported by the PE shop saying our loans are worth X amount of dollars. Then there's like a publicly traded fund run by the same PE company. That fund happened to trade at an 80% at 20% discount. So the public market said that the value of their loans, and the two funds have 99% overlap. There's like maybe slight differences, but like it's substantially the same portfolio of loans. The public market said the loans are worth actually 80 cents a dollar. This was after uh, a new GPT model came out, and there's a concern that software as service companies were struggling. And PE had made a bunch of these loans to like middle market companies in Chicago. And the idea was like, why would I pay the Chicago company? I can just do everything in house using ChatGPT. And at this time, this is like March of this year, all of these loans started trading down significantly, but the privately held valuations of these loans did not change or did not change enough. So everyone sort of saw this. There's like a private uh, fund that is trading at 100 cents a dollar on the private market. Same assets are trading 80 cents a dollar in the public market. And the investors want out, the sophisticated investors on the private fund. So Blue Owl tries to go on the market, and a transaction's announced where Blue Owl's own insurance company called Quave. I forget the name.
Kuvare, I think.
Yeah, and they buy the loans at 99 cents a dollar from Blue Owl, where this again the same loan is trading at 80 cents a dollar in the public market, and the insurance company bought the loans at 99 cents a dollar, and the LPs who exited were endowments and sophisticated LPs. So that's like one example of a transaction where sort of there's like some proxy price. We all kind of in the public markets thought the price was 20% discount to the loans, but the insurance company is buying at an inflated price compared to that public market benchmark. Again, that's one example. There's a paper we cited, an empirical paper that shows when PE companies buy affiliated company assets, they're paying, something like 10 to 40 basis points higher for the same asset on the same day when it sells to one time when the insurance company is buying, when like a non-controlled buyer is buying. So you can see that like broad based in the data as like an average, but it's also happening at this Blue Owl example is very stark. But the basic idea is like Yale is very sophisticated. They're monitoring really well. The policyholders aren't monitoring, and so the PE company is able to like pay a higher price to Yale because again, like I don't know what insurance company is buying what loans, right? Like the NAIC is supposed to be looking into these affiliate transactions, but I'm sure we'll get to that later. But the rough story is that they're not doing a good enough job of policing these kind of affiliate transactions.
Andrew, anything else on that?
Yeah, so I think with the Blue Owl transaction and with all of these in general, the extent to which this is a problem, I think is kind of endlessly empirically contestable because the valuations of these assets are sort of like difficult to do. These are often, bespoke, individualized loans. And so, what exactly is this loan worth? Well, that's very hard. It's very hard to figure that out in kind of a like an objective sense. I don't even like how do you even begin to do that? And it's exactly that opacity that enables, actors who are kind of closest to the ground. So in this case, that would be the private equity firm that, that owns these loans to be able to leverage information asymmetries. Like you could have potentially, in theory, a perfectly clairvoyant regulatory regime that would be able to crack down on this, but like obviously that doesn't exist in the real world. We're stuck dealing with, with the kind of limited information that we have. And so while the extent to which this is happening, we could have a fight about that forever. What we want to point out is just that the incentive to conduct these kinds of kind of internally favorable transactions is just permanently there whenever you have a private equity firm that owns, both like the company that is like on the receiving end of the loan and the life insurer that is holding the loan itself, or that could be the holder of the loan if transferred by a different, affiliated private credit fund that is also part of the same platform.
Yeah, they have a real incentive to lie. But if you look as a PE company, but if you're looking at it from the standpoint of the policyholder or the taxpayer, you want there to be an incentive to tell the truth because you want the proper amount of capital in the insurance company so it doesn't go belly up. So these seem very much at odds here. And we can come back to who could be looking at what these are worth when we get to the rating agencies, but we'll get there momentarily. You've got third way PE firms may be looting their insurers. PE firms may reorient insurer portfolios toward affiliated, structured, and private credit that offers higher promised yield but creates greater loss and severe stress. So I think this gets at a little bit of maybe two things. I'd like to get more clarity on this. One is just like this isn't the Warren Buffett by we're gonna or the classic insurer model. Hey, we're gonna invest these premiums and this money that we're getting from the policyholders, and we're gonna invest it in AAA assets or money good at whatever good, very highly rated assets, safe assets. We're we're going into risky assets, high yield uh, assets, and you also mentioned structured. Is there anything about how they
Yeah.
structure these?
So
Yeah, and the high yield. Yeah, go ahead.
great. So the basic point is that a, an insurance company makes a bunch of content investments. Sometimes they hold cash. They make some like AAA, AT&T, like super safe stuff. Then they invest some in treasuries at different parts of the yield curve. And then they hold equity positions in like a CLO, which is like more risky. And what P's done is that they've transformed that by investing in private credit, which is generally higher risk in that if you just look at how much private credit moves out to the market, it moves more than like AAA rated bonds. And you can, this doesn't, you don't need to be like a genius. It's like, who are they investing? Like, who is holding the median private credit loan? It's usually a smaller company with more contingent cash flows that is usually more exposed to like software, and it's so it's like very different from sort of like publicly traded bonds. Now, again, conceptually this would be okay if we knew the true risk. So the idea is the insurance company holds all kinds of different assets that carry different kinds of risk, and private credit is just one kind of asset that is more risky than other parts of the portfolio. So if there's like a clairvoyant person who can see all risk, you would just say, insurance company, you're holding this like risky loan, hold more cash, right? But the problem is that since valuation of these loans and assets is difficult, especially difficult for the regulator, who has to trust the ratings that the insurance company provides. And there's a thing called private letter ratings, where only the insurance company, the regulator, see the rating, and it's not public. So it's very hard to even track what rating was this given, uh, how do you check were these ratings benign or good? Because you can observe loan defaults. So you can check when a thing gets a double A, what are the probability of default historically and in bad times. But with private ratings, you don't know that. You don't know the what the asset got. So it's hard to like do risk-based capital solvency regime stuff. So the basic point is that private credit is hard to value. Structured securities are also hard to value. And by loading the balance sheet with these assets, what you're doing is you're getting the same rating as hypothetically a AAA publicly traded AT&T style bond, but you're making more, it's higher risk. So like functionally it's higher risk, but it looks like it's as safe as a publicly traded bond. And that creates this weird incentive where in the upside, where like equity markets keep going up, all the loans get paid on time, you're making more money because you're holding higher yielding assets. But in the case of a downturn, you push into insolvency. The point is that since the guarantee fund system socializes everything, in the downside case, you're not, it's like the policyholders lose out in the story we've already talked about. So the basic idea is like by holding riskier, hard to value loans, you're having higher upside and then a lower, but the downside risk is protected, so you're incentivized to do this. One more way to think about it is it also penalizes good insurance companies. So like say there's two types of PE insurance companies without even thinking the Warren Buffett example. So there's like one insurance company that's owned by a PE company that has access to really nice private credit that is actually AA and like very safe and also yields higher because they like have a better technology to lend. And that's like a plausible argument. So you like, they invest in, I don't know, Anheuser-Busch in this like massive private credit loan that is the size of a publicly traded loan, but more bespoke. But there's like a crappy private equity owned insurance company that doesn't have access to make these like super big, really nice, safe loans. And they invest in these like kind of crappier loans. Because of the ratings opacity, their loan looks the same quality as the safer loan. So all the companies have an incentive to like move up the risk chain because the idea is like, oh, I can just look like I'm making a safe loan. So what's the point of making a safe loan? You always want to make the risky loan that looks safe as opposed to making the truly safe loan. So this sort of like valuation opacity also penalizes like a really sophisticated PE shop that has access to like really good loans that a smaller or like a crappier PE company might not. So in the paper, we don't talk about this right now, but like our like hunch is that the sort of the most concerned regulator should be are these smaller PE-owned insurance companies that are like more fly by night, as in they have a greater incentive to take more risk because they have less to lose. And we see this in the data in like different contexts where like firms that are smaller tend to be more willing to like take on more risks. So if they go in distress, it's less costly. So you might imagine like a smaller PE-owned insurance company that doesn't have access to all these like high-flying good assets will just invest in crappy private credit, overinflate the risk, and then like if they go under, they go under.
I guess my only pushback would be I don't understand why a big one would necessarily be any different. They have the same exact incentives for the most part, except maybe they don't have these special access to these special things, but special great deals, but they're doing the same types of deals. And,
Yeah,
if they didn't have these problems, they wouldn't need to buy the insurer because they could sell the private equity thing anyway. So I'm a little bit more skeptical that the big ones are any better than the small ones. I would say the safe ones are
right.
also being harmed by
Yeah,
unfair
totally.
method
Yeah,
of competition because in those 10 states where it's not offloaded on the taxpayer, they take it on the chin, right? They're going to be
yeah,
the
yeah.
ones bailing these guys out in California, Maryland, and whatever the other states that don't have the tax credits. Andrew, anything else to add?
Yeah, so just that, so the private equity owned life insurers have been, in the vanguard of this transformation of the balance sheet of the insurers. They have been really pushing into private credit. They've also really been pushing into, asset-backed securities, CLOs. But we've seen non-private equity owned life insurers in recent years also increase their investments in these more opaque types of asset classes. I think kind of following the lead of these PE owned ones who have shown the proof of concept, which is that, it turns out you actually can just invest in these much higher risk assets and you won't be penalized for it in by the regulators.
Yeah, that seems problematic. I think in the paper you still mentioned it's a lot lower in terms of like the
Yeah,
aggregate volume, but like yeah, it's and the other thing I think you've mentioned before is you're not just competing on the asset side. If all of a sudden you're taking higher fees and taking higher rates and getting higher returns and things like that, you can offer better terms
yeah.
in the near
Get
term
more market
for
share.
for
Yeah,
the annuities,
yeah.
get more annuities in. But, are you going to be around in 10 years, 15 years, 20 years? We'll see. And by the way, if you're not, it's the taxpayer and the policy holder who hold the bag. All right, fourth looting. And by the way, we'll get to questions. We got some listener questions already. If you have questions, please put them in the chat. Please put them in or the Q&A panel. We'll get to them in a few minutes. I just want to get through the rest of these looting uh, strategies. PE firms may engage in valuation arbitrage with NAIC's risk-based capital regulatory regime to make their private credit assets look systemically less risky than they actually are. What are the strategies here?
Yeah, so we've three and four are kind of a pair, so we've been talking about them together. But the point I would add here is this mechanism called a private letter rating that has been the subject of a lot of controversy and the subject of a lot of recent literature in economics. A private letter rating is as the name suggests, a rating that is itself private. So when insurers have to go to the regulators and make, attestations about the level of risk that they're holding on their balance sheets, what they do is they go to a credit ratings agency, which is a private company, just a different private company that does this sort of work. And they say, like, please give us a letter rating for the amount of risk that this asset entails. That agency gives a rating, and then the insurer reports that rating to the NAIC. And the private letter rating, is private to the ratings agency, the insurer, and the NAIC. So no one else is observing, what these private letter ratings are. And these have been the subject of so much controversy, in particular because of a ratings agency called Egan-Jones, which, there's been a lot of reporting on Egan-Jones. This is a very small rating shop that has churned out a vast quantity of these like private letter ratings. And to the extent that people have been able to do empirical studies on them, they continually, over and over, find wild levels of optimism. Um, some ratings studies estimate that there's maybe kind of three notches on average worth of optimism. And so Egan-Jones is quite controversial. The Bermuda Monetary Authority has stated that they will no longer use them. They're no longer kind of acceptable for use under their jurisdiction. But I think would also be incorrect to kind of lay the blame at the foot of a single ratings agency. All ratings agencies suffer from that agency problem that was talked about a lot in 2008 because, banks have a somewhat similar system. They also have credit ratings agencies. And, when the bank, or in this case, the insurer, is the one paying you, you have incentive to keep them happy. You, as the ratings agency, have incentive to keep them happy. And what would make the insurer happy is if you said there's very little risk in this rating. Um, there are incentives pushing in the other direction, of course, if your credibility over the long run matters. And if you seem like you're just not credible, there is a threshold upon which people will kind of cut you off entirely, as Bermuda has done with Egan-Jones. But in these, kind of cases of highly opaque assets where valuation is just inherently very difficult, that creates a lot of room to maneuver in terms of pushing these ratings up.
And you don't get this in your paper, but NRSROs are regulated, I think, by the SEC, and that came up a lot that the SEC should do some reform in Dodd-Frank. That hasn't occurred in any meaningful way, really. Obviously, with Egan-Jones running amok here, as you pointed out, there is, and I wouldn't be too enthusiastic about the SEC's likelihood of doing anything now, just given the staffing levels there and just the willingness to sort of deregulate, or otherwise look the other way when it comes to accounting issues. But do you think NRSRO oversight,
Yeah.
you mentioned, federal policymaking could get involved more broadly if there's lack of scrutiny at the state level? Could, you know, even states that do securities regulations, I mean, anyone that kind of looks at ratings, at the state or federal level could poke around here in terms of what the quality of these ratings are and whether or not these NRSROs are doing something in the
Totally.
public interest or what have you.
Yeah, that would be like a one way, that would be a very like reasonable fix. The problem is just that anytime the NRSFRs exclude a rating agency or include an additional one, the fundamental agency problem is that the insurance company is paying them, so they have an incentive to like make good ratings. So the sort of solution would be either like auditing them or like
Yeah.
randomly sending some loans to like the big three. You just sort
Encouraging
of
other models. There's investor pay models. There's subscription
yeah,
models. I mean, yeah, this has
yeah,
been
a
basically what I
classic
remember
problem.
about
Yeah, yeah,
Dodd-Frank. They threw out all
yeah,
these interesting proposals and did none of them, right?
yeah,
They
yeah,
said,
yeah.
yeah, we're actually okay. We'll have a little bit more competition. And
And the
instead
problem
of,
with the competition idea is that like competition actually is the problem in some ways here, where the small like Demotech and Egan Jones, their like business model is we use AI, we do 7,000 loans a week. So like since they do these
yeah,
high volume ratings, that's what creates the problem. Where like
it's a
S&P
race to
is
the
doing
bottom. It's
yeah,
not
exactly,
competition, it's
yeah,
a race to the bottom. I mean,
yeah,
yeah,
yeah, yeah,
competition without rules. I mean, you get a race to the
yeah.
bottom. I want to get to listener questions. Let's get to my last ways that PE firms loot their insurers. PE firms may expand the use of opaque shadow reinsurance that conceals risk. This this really got me. This really got me because you in the paper show, look, these NAIC, these state regulators, they're not really doing anything. They're not really doing good oversight. I mean, they're making reforms on the margins. They're too little, too late. They're just not effective. They don't have enough staff. They don't have enough resources. It's kind of a you know, uh, one at a time way that they look at things. There's so much more sophistication on the side of the PE firm and the insurers. They're just running circles around these state regulators. But then in the paper you say, and we've written a little bit about this as well. Well, that's not enough. The way that they're, engaging in valuation arbitrage, aka duping the state regulators and NAIC, capital requirements. That's not enough. They need to go one step further and use shadow reinsurance. Have these sometimes captive reinsurers offload some of that, some of these holdings, some of these policies to a reinsurer, and then book that as like an asset or whatever. I'm not sure I 100% understand it, but the idea that you need to go even another layer further to trick the state regulator just seems mind-boggling to me. Please tell us about this shadow reinsurance and whether or not you were surprised by how much it was going on.
Yeah, I think, you know, this to me, I think is really egregious. I want to say like I have a lot of sympathy for the problem that the NAIC has to deal with. I think it's a very tough job trying to manage this situation. But I think the kind of fundamental structure of insurance regulation in the US, where like under the McCarran-Ferguson Act, this is like devolved to the states and then they're trying to coordinate through the NAIC is just a very difficult structure for trying to deal with the scale of the problem. And shadow reinsurance is, I think, a very clear example of risk shifting and hiding risk. So what this means is, a reinsurance transaction just means that an insurer takes some of its liabilities, which are these kind of like actuarially estimated, reserves that it expects that it will have to pay out to some policyholders because some policyholders are going to die, and then they're going to have to make payouts to the beneficiaries. So we have some of these, liabilities, and then we also have some assets on the asset side of the insurer balance sheet, and the insurer can transfer risk to just a different insurer. And in and of itself, that's a totally legitimate transaction. The insurer might totally reasonably decide, well, I don't particularly want to hold this exact risk. I'm just going to pay someone else to take on that risk for me. And if you were doing this in a competitive marketplace where the reinsurer is a separate company and they're negotiating, we reach some sort of negotiated transaction to value these contingent liabilities. We make that transaction, that's all fine and good. Captive reinsurance involves reinsurance to a subsidiary of the same company. So you're kind of, you have, if you have like a family, you're moving risk around within the family, but it's still fundamentally all under the same, kind of ultimate corporate entity. And shadow reinsurance, what that refers to is it refers to captive reinsurance to, certain jurisdictions, because you can have the reinsurer be in a different jurisdiction than the insurer is, where there is kind of systematic opacity. This involves most prominently Bermuda. States can also compete for reinsurance business by offering these sorts of terms. States like Iowa and Vermont notably do this. And so even though the data that you get on an insurer's balance sheet is very strong, if you look at the insurer itself, once you reinsure to a shadow reinsurer, all of that data goes away. And so you really have no idea then what the reinsurance company is doing with its assets. You have no idea if they have enough money to be able to pay for the expected liabilities that they are going to incur. And this, I think, is just a really stark example of being able to just shift risk off of balance sheets in a way that makes it almost impossible for any external observer to be able to tell what's going on.
It was I mean, it's shocking to read about, to see how much is going on, that it's allowed. There's just so many problems with this shadow reinsurance. I know that's something we're going to focus on writing about. I want to get to listener questions really quickly. But before we do that, I wanted to ask, can you give us a few examples of reforms that you would like to see that you think would nip this type of conduct in the bud or address some of the problems that you've seen from what's going on? And then also, have you gotten feedback from regulators, interested people to reform this? Because like it seems like this could be a really big problem. I mean, I was saying before the call, before we started talking, it reminds me a lot of 2008. It's a lot of assets we're talking about. Yeah, maybe it's not in the banking system, but seems pretty like there could be a lot of contagion, a lot, it's not exactly potential for run on the bank, but there are some potential elements like that, cascading issues. Maybe they couldn't deal with multiple failures at once. Maybe they couldn't deal with a big national failure. You get bailouts. It's a sympathetic customer. I mean, you could see this going pretty haywire, similar to 2008. So would love to get your, recommendations for reform and like if you've started to hear any feedback from people who are want to improve this situation.
I can talk about one set of reforms, and I think we just got an email from a regulator, but so the timing there was great. But so there's two sets of reforms. One is like before there's an insolvency, and one where so what to do before any bad things happen. And then the second set of reforms would be how do you make the guarantee fund system better that deals with insolvency. So I'll do the first part, and Andrew can do the guarantee fund stuff. So the basic core problem again is that private credit is opaque, hard to value. So a lot of the energy, I think, and the NSE has been doing things on this for last few years, realizing the problem. The basic sort of solution would be to have better valuation. Now, what does that mean? That means more scrutiny of private letter valuations, but also there's like a fundamental difficulty in valuing illiquid assets. So it's not solvable fully. You might imagine a better regime that like audits certain ratings agencies, or maybe everyone pays it, all the insurance companies pay into a fund that the state regulator then like uses to get their own ratings from a different ratings agency like a big three or something. So there's stuff like that. You can also just penalize insurance companies for holding opaque assets, just broad based, where the idea would be that, it's very hard to value illiquid things and complicated things. The regulator's always behind the eight ball because they have to like police each transaction and each loan. That's very costly. So instead of like the regulator doing loan by loan, they just say, look, if you hold X% of your assets in opaque private credit, you'll pay a premium for the deposit insurance today. No matter how risky the assets are, it's just the difficulty of valuation we're directly targeting, like a Pigouvian tax on opacity.
Yeah, and another bucket of reforms to mention briefly is aligning incentives in insolvency. So, one thing that you could do is you could say, well, if a life insurer goes bankrupt, you could give the kind of the receivership like administration a claim against the insurance holding company if there is one for some percentage of the guarantee fund assessment. So to say that in English, if the rest of us have to pay for the policyholder bailout, the kind of controlling company of the insurer should also be on the hook for at least part of that policyholder bailout. And so what that does is it, means that, kind of ex ante, like prior to the insolvency, the controlling entity, like say it could be like the private equity firm, or there's many other insurance holding companies, they will be making decisions knowing that if that insurer were to go down, that they would be partially on the hook for the liabilities that are also spilling out to everybody else.
I want to have you guys back after your next paper so we can talk more about solutions. We've got some listener questions to get to. First one here, Bright House Financial. Have you looked at that insurance company at all? It just says Bright House Financial question mark. No.
Yeah, so we spoke with the Charlotte Business Journal about the pending acquisition of Bright House Financial. I think it's always very hard to comment on individual transactions because the facts in any individual transaction are always highly disputable. And so I think we would just note kind of the incentives at play in that transaction are the incentives that are at play, broadly speaking, whenever a private equity firm acquires a life insurer and also has, these buyout funds and private credit funds.
Another question here. Yesterday, Andrew tweeted information that expressed concerns about insurance companies' use of leverage. 20 to 1 and 50 to 1 leverage was mentioned. Could you please explain how this leverage is achieved?
Yeah, so insurance companies tend to be pretty highly leveraged, as are banks. What that entails from a financial stability perspective is that, the higher the ratio of your debt is to your assets, the more, kind of like fragile your company is in terms of the risk that you would ultimately go insolvent. Like the less it takes for a decline in your asset value to, push you into a technical insolvency where you just simply do not have enough assets to cover your liabilities. And so leverage here, I think, is quite important, particularly as the asset side of these life insurers gets more and more risky. You start pushing these bounds more and more intensely.
And when you think about leverage, how are they getting so much leverage? Is it because they're keeping as little, I mean, like capital against their liabilities?
So
And why is it bigger now? Is that not regulated, or how do they end up being more levered than typical? And yeah, and we've got a question here. How does that leverage ratio compare to 2008?
Um, I I looked at this a while ago. I don't want to say specific numbers because I don't want to get it wrong. But the idea here generally is that if you are a life insurer, your liability side is actually kind of unique. So you do have direct creditors. So like investors can make direct loans to a life insurer, but the bulk of most life insurers' liabilities are these actuarial reserves, which are, an accounting construction where we're trying to estimate to the best of our ability, what the liabilities of a life insurer are. And you get these through the kind of classical insurer function of risk pooling, where, if I'm an insurer, I sell, 100 life insurance policies that say they last like 10 years. you know, like some number of those of people who I issued policies to are going to pass away, and then I'll be on the hook for the payout to their beneficiary, but I don't even know who those people are. I'm making an estimate, and that estimate gets more precise as the number of policies that I issue increases. And so the calculation of those liabilities is a kind of a technical matter of actuarial science and accounting, but in general, it is true that the kind of equity on the balance sheet, which is just mechanically the total estimated asset value of the insurer minus that liability calculation for the insurer, there's not that much left over.
Got it. And the last question, we'll let you go. I mean, is part of this is I think this question gets at like the urgency of the problem, like how things could go wrong. What level of bond impairment needs to happen for it to trigger financial and liquidity issue? If we go into a recession, these loans marked at par go to 70%. How much systemic risk would that cause for the industry?
I was just typing an answer to that. But the basic idea is it's complicated. So I think there's this paper from a person we know at NYU. They estimate that in current stress scenarios, if private credit is like a moderate credit scenario, they'd be fine. But in extreme distress, say like impairments of 15-20%, that would wipe out all the equity. But it's like a very complicated question because you need to understand like the correlation between private credit and different asset classes that the insurance company holds. So any sort of credit impairment will then affect both AAA safe bonds and private credit, which is inherently more risky. So you just need to understand how they move together, which is like a hard empirical question. And sophisticated people disagree and whatnot. So it's hard to give a great answer, but like I don't know if it's like 15% of the balance sheet and the 20x leverage, 3 or 4% impairment of the whole balance sheet is enough to like wipe out equity. So if you think about it like that, it's like, oh, 30% or 15%, you can quickly go to like crazy numbers. So but again, it's very hard to like do this hand waving.
I mean, my thing, it feels a lot more fragile to me just because like you're already bumping up against these NAIC risk capital rules. You've
Yeah,
got the shadow insurance. All it takes is for some law enforcement person to come along and say, actually, you got a lot of affiliated things here. You need more. Those are risky. You need more assets. That's what's happening with the guy who owns the
the Dodgers.
Dodgers
Yeah, yeah.
and the
Mhm.
Guggenheim and Walters, whatever, or or actually, these assets are marked wrong. You gotta make this more accurate. This is what happens with Blue Owl. You
Yeah.
can see that just the transparency alone actually resulting in a lot of risk to the current model. Like no credit impairment needs to
Mhm.
necessarily happen for some of these guys. Is that the wrong way to think about this? Or I
No,
mean,
that's
it
right.
seems
I think
very
the
fragile.
totally. I think so. Yeah, like in the Dodgers case, do more. Like you need more non-affiliated assets. So they have to go buy them or sell the Dodgers part, do something. Again, this is where the insurance liabilities are in some ways a benefit because they're so long dated that, like, look, if a regulator spots problems early, it's not like things are screwed. We have time to fix it. And an insurance company can slowly offload the bad asset or whatever the regulator is asking. Unlike in like other contexts where there's more runnable deposits, like in insurance, since there's like less runnability, you have more time to fix problems if there's no credit impairment.
Oh, well, actually, I've got one last question. I promise I'll let you go. The runability. I actually did have a question about this because you mentioned three kinds of life insurance. You mentioned term, you mentioned annuities, and then there was this other one that involves like investment-like accounts, kind
Yeah,
of
so cash value life.
Mm-hmm.
cash value life. So, and you can call that back. Like you can get that back, right? If you're a life insurance. So if the life insurance policyholders get wind of you doing this stuff and they're like, actually, I have like a 401k like asset in there, just give it back to me. Does that mean that there could be a run like situation at some of these guys? And or is that amount of money in the insurance company not enough to come into play in that respect?
Yeah, so this is the next paper.
Ah,
Yeah, so
yes.
how permanent is permanent capital? It depends. I think it depends a lot on the kinds of product, like the different types of product lines, what percentage they are of the insurer, and then here's just one example. So if you have an insurer that sells a lot of low value policies. Let's say almost all of your life insurance policies, are 150 to $200,000 of death benefit, or maybe much lower. Maybe you do just like kind of 10,000, $20,000 death benefit policies. All of those policies are going to be fully covered by your every state's guarantee fund. So there's no incentive for any policyholder to ever run from that. But if you have a ton of very high value life insurance policies, 1 million, $2 million more in death benefit, well, then that 200K, 300K of protection starts to look kind of paltry. And so those two life insurers, I think, are in a very different position when it comes to, what incentives their policyholders have to try to retain attachment to that insurer as that insurer, hits financial distress. So we're gonna have another 60 pages
Yeah.
about that, hopefully in the next few months.
And I'll also answer Ben's question, who asked about the government-run life insurance program. So I think, as Andrew was saying, there's like these like types of policies. One of those policies, like if the idea is just invest in a 30-year treasury and then give you the proceeds of that, that the government can run well. They already do that through this. The life insurance for federal employees is run by the government, and they make all the investments in non-private assets. So they only invest in government-owned treasuries, and it works well for that, but it doesn't work well if you want like these more exotic policies that invest in like high yielding assets so you have a higher payout for your spouse. There, I don't really think the government could run like a sophisticated life insurer, or even because even the federal employee one is partially outsourced to MetLife. So yeah, in short, I'm like skeptical of an idea like that. I think we're better off like sort of because also the other point is like there's a lot of competition in life insurance. It's like in the grand scheme of things, like runs fairly well. It's just we need to figure out the solvency regime and deal with this problem more directly. Yeah.
Yeah, it runs very well until it creates a credit crunch and financial collapse. But I am excited for your next paper. I would love to have you back. This was incredible. Again, one of the most informative, interesting, readable for an academic paper. Just so great. I can't recommend it enough. Please go read it. Please, please, please read it. And I can't thank you enough for joining us, Pranjal. Andrew, this was a true pleasure.
Thank you so
Thanks
much
for
for
having
having
us
us.
on.
Awesome.
All right. And thanks everyone for joining us. This concludes the call. Bye-bye.
Bye.